Chapter 10 Maximum Rate. The Interstate Commerce Act requires the rate of the interstate commerce jurisdiction to measure the however does not specify the manner of the interstate commerce evaluate with maximum reasonable rather than levies the interstate commerce authority to establish standards and guidelines will apply with such determinations. Maximum rates. Chapter 10. Presently, the interstate commerce has not established a comprehensive policy regarding the use of the cost of evidence and the assessing maximum rate reasonable to count on coal commodities in the past for the interstate commerce committee relied on various types of evidence, including the evidence of revenue cost, the relationship with the cost of evidence, included the variable cost of the value allocated with the cost standalone cost based on the variety of the approaches incorporated the range of the cost of the capital. Interstate Commerce Commission considered the evidence along with the evidence on the case for the case basis in part ex parte with the number 347 the coal rated with the guidelines nationwide with the interstate commerce about the standard the SAC appropriate for the maximum rate of the case involving the resultant of the SAC standard accounting cost. Also simulated with the competitive marketplace if the cost of the efficient competitor for the market with the special entry with the existing barriers could be provided with the specified code with the challenge rate. Or with other cost information with relative to the maximum rate reasonable determination of the interstate commerce constrained marketing pricing guidelines. The standard accounting cost is the sole coal cost test with the maximum reasonable with the cost coal transportation rates. And rate responsible case for the traffic other than large movement of the coal of the interstate commerce grant proposed with the alternative standard for the addition with a full constrained marketed principle constrained marketed pricing with the presentation alternative standards proposed for the ex parte number 347 the rates of guidelines on coal proceedings are intended to provide with the burdensome means for the achieving of the constrained marketed principle result with since the ICC believes the constrained marketing price is most sophisticated and accurate method of determining the maximum rate reasonable because the standards have not been adopted for the date of this report will not be specifically addressed with the Railroad Accounting Principle Board. Other application maximum rate with the cost evidence such as the presented with the Interstate Commerce Commission suggested with the Railroad Accounting Principle Board commentary with the proceeding by the Interstate Commerce Commission by the expert number 347 super number 2 but involves the computation of the variable for the subaggregate with the standalone cost of the application typically based for the government purchasing costs for the system such as the RFA, and the railroad funding or the uniform railroad cost system, the adjustment they incorporated the measure movement of the specific cost information of the operating characteristics of the railroad accounting principle board. Similarly, for these standards of accounting costs, the Interstate Commerce Commission may allocate the excess of the regulation over the total standard accounting costs and they determine a rate of reduction in individual measures standalone shippers group. These allocations rated setting of the cost problem. I guess the SAC standalone costs. Railroad accounting principle whenever the cost of the use of the maximum rate, however the application would vary among the specific maximum rate depending on the type of the cost, but the Interstate Commerce Commission required the maximum rate responsible to the decision, for example, the particular region for the asset valuation principle is applied with the different with the standalone cost for the variable cost for the government purchasing cost of the system. The principle required the current market asset valuation for the standalone cost of the permits for the other measure for the government purchasing cost system. The chapter explanation for the principles will add maximum rate pertaining to the specific standalone cost since the Inter-Commerce Commission stands the constraining marketing price and guidelines for the coal, including the standard alone cost testing. The explanation is based on the Interstate Commerce Commission constraint market pricing and requires modification of the subsequent Interstate Commerce Commission departure from these guidelines. Our application for principle of the maximum rate cost of the complication of the standalone cost of the maximum rate of the application of the principle applied to the section addressed the application of the principle which are likely to be most used for preparing the standalone cost evidence. The casualty of the principle is applied with the standalone cost for the inclusion of the cost which would be incurred by the hypothetical competitor provided with the service of the shipper. The good group of the shipper. The principle permits the cost of the relationship established through the director observation, engineering, and statistical techniques applied with the standalone cost of the three approaches differ, but the underlying assumption directs this observation typically reflects the specific portion of the existing railroad facility's operation segregated with the facility operation with a hypothetical competitor and engineering analysis based on the general physical relationship between the quantity and the mix of the input and the resources required to produce the quality of the output rather than relying on the surrogate cost information from the particular existence of the railroad. Statistical techniques are applied with the government purchasing cost system produces the railroad-wide average unit with the cost segregated with the unit cost of the hypothetical competitor. The Railroad Accounting Principle Board has not established the hierarchy of the performance of the approach with establishing the casualty after the historical railroad costs that are used for the direct observation statistical techniques and should be exercised to ensure the physical operating characteristics surrogated with the railroad comporter with these hypothetical competitors. Casualty principle discharge the portion of the allocation of the joint cost among the activities where the relationship between the insurance with the cost of the joint performance the activities responsible for among the activities determine the cost of the standalone competitor, such as the allocation for the void determine the cost of the entire standalone entity, but the revenue of the traffic that handled with the standalone competitor exceed the total standalone cost of the maximum reasonable rates for must be set by the Interstate Commerce Commission. The casualty principle recognizes that it may be the short run, intermediate, long term, depending on the specific regulatory application of the standalone application relevant to the typical long run since the relevant time of the period hypothetical competitor considering entity. Market expected with the standalone entity operation, the expected life depends on the assumption market with regard to the period over with the standalone railroad traffic is expected to move. Alright, homogeneity. Average cost of the commute with the interchange with the resource according to the homogeneity principle, many with the cost for the hypothetical competitor with the exchange interchangeable since they no expense but they have been incurred with no assets actually have been acquired. Average cost of the interchange of the resource may be used for direct observation of existing operations surrogated with the hypothetical operation engineering methods. Standalone repair cost projection based on the historical coal pool locomotive repair experience provided by the example the hypogeneity with the repair specific use actually handled with the complaints with the railroad movement specifically identified by the average pool repair cool should be used at all coal pool locomotives actually equal chance for the complaints with the movements. Practicality principle. The practicality principle offers guidance with the computing with the standalone cost relevance is higher than the rate of the case for the recognized the detailed engineering analysis for the complex standalone railroad network conceivables could exceed with the potential transportation with the cost of the saving for the ship of the preparation, the standalone cost for the feasible. In such a case, the practical principle also remain reasonable and estimates necessary. Data integrity because of the cost of the hypothetical competitor necessarily estimates reflect the degree of the judgment, the data of the integrity principle that was supported by the underlying source for the record of the explanation of the rational key assumption regarding the source of the judgment, the discovery, the rebuttal with the procedure for the adversely proceeding with the appropriate mechanism to ensure the data integrity. Alright, NE3, the NE standalone cost of the transportation network reported by the hypothetical competitor. Cost of capital typical important for the component of the standalone cost of the there are three major components cost of the capital asset valuation capital recovery. Three components determined in the cost of the capital principle the asset valuation related with the expense of principal. The cost of the capital is determined by the cost of the capital principle for the standalone cost of the nominal cost of the capital comprised lies with the weight of the average cost of the capital, the equity of the capital, and the appropriate discount rate with its DCF analysis for the use of the most capital appropriate method measured for the analysis with another tax cost capital rate be used in either the cost capital rate nor the asset base for the needed required adjustment. The deferred tax, the cash flow effects of the tax is recognized directly in the cash flow of the computation of the cost of the capital should reflect the financial risk of a hypothetical competitor. However, the computation of such a rate is impractical. The Interstate Commerce Commission directs that the rational rate with the rational rate may be used. As noted with one of the commencing parties, if approached with the DCF is used, the care must be taken to avoid double counting inflation of the capital costs. Asset valuation related expenses and applying with the asset values related expense principle the standalone cost of the current market value at the time of the entry, including with the special entry with the existing the barrier cars should be used. The current market valuation does not require the new competitor to acquire all the new assets. Theoretically, a new competitor would acquire with the asset that makes advantages similar to those the existing railroads have with the current competitor valuation assets similar productive capacity as to remaining alive than the rather historical cost of relevant valuation standalone cost. For example, the complaint shows but they include the cost of the use of the standalone railroad. Such must be with the current market of the past, but the railroad designated age of the exemption of the remaining of the useful life of the recognized accordingly the resulting rail costs when the compromise of these costs with the recovery inducing the entry of the hypothetical competitor. In most cases, the capital recover the annual return, but the return of the asset should be returned with the estimating the annual cash flow through the discounting using the after-tax nominal capital rate to recover the original asset value of the capital recovery. The methodology known as the DCF approach requires the exclusion of the non-cash expenses such as the depreciation and deferred tax of the annual cash flow computations. DCF method is preferred approach with the appropriate method may be used for any of the method time value of money of the recognized. Analyzing, supporting the rejection of the change for the application of the cost of the capital asset valuation related with the extent principle required for the selection for the among the alternatives the specific standalone cost of the cost of the capital is rated with the integral component of the capital cost standalone computation of the railroad accurate on principle board with the rational selected in the current nominal location for the capital rate with the application discussed in chapter 6 of the cost of the capital with the treatment that deferred with the standard accounting principle computing with the measurement with the several commanding parties such as the benefits with the deferred tax that should be reflected with reducing revenue requirements with the standalone competitive alternative treatment for the deferred taxes, standalone costs deferred with the railroad accounting principles discussed in Chapter 7 and incorporated the deferred tax of the zero component with the cost for the capital rate. Deducted deferred tax with the hypothetical competitor asset base direct recognize the tax consequence of DCF analysis and recognize the tax expense with the comprehensive interperiod tax allocation method. Third alternative was preferred by the railroad accounting principle board. Potential investors would include only the cash flow effects of the taxes and investment analysis and ignore the non-cash flow deferred tax. The other alternatives of the recognized deferred taxes imply the deferred tax both. This is compromised the predetermined fixed portion of the investment asset base. The assumption may not be appropriate for the new entry, but the alternative in the use of the comprehensive and interior period tax allocation would oversight the revenues required for the inducing the potential investor on the hands of the market. Alright, assets evaluation related expense of the commentary is divided regarding whether the historical current market evaluation should be used with the standalone cost of the survey. Interval commentators supported with the exclusion of the use of the current market valuation. Other the commenters suggested the use of either the valuation was acceptable along with the inflation and not recovered twice. The ones of the commentator the historical cost of existing the railroad should be used with the ceiling for the sink of the investment to prevent the including of the entry of the base bare assets of standalone cost. The current assets evaluation of the standalone cost theoretically appropriate. The standalone cost represents the cost required with the hypothetical new competitor the asset valuation perspective nature of the asset born with the defendant railroad and path of the irrelevant extent that must be used and estimate the very asset used with the standard account and determination of the extent with the pose of the specific entry of the exterior barrier cost. In addition, practical purposes and problems associated with using the current evaluation of the general company wide with the application to diminish for the standard accounting cost analysis because of the scope of the standalone competitors' network is likely to be less than defendant's entire railroad. The asset values are hypothetical rather than actual consequent low. Consequently, railroad restricted do not need to identify the value, the potential problem of double counting with the inflation and capital costs avoided applying the DCF capital recovery method. The method of determining the start of the revenue of the cash flow discontinued the normal cost of the capital rate instead actually recover the investment. Example, they're applying with the DCF method for the present on page 69. Several commenting parties are addressed with the associated with the entry and the exterior bars and the next of the many of the railroad costs that are related with the level of the capital recovery the standalone cost for the one party of the state, but the difference between the cost of the sunk with the past for the existing of the railroad cost for the benefit sunk with the hypothetical entries, but the successful entry bears and other part stated that the capital recovery is long life assets relatively short period with the concluding with the life of the traffic may result in the overstated the investment costs. Railroad accounting principle believes that the problems tend to be interrelated with the investment cost not sunken with the remainder economic value can be recovered under the excess for the market, but in such a case, the life of the standalone railroad is equivalent. Conversely, an investment would be sunk with the cannot be recovered upon the existing of the market. Nevertheless, sunk investment can be incurred by the existing railroad hypothetical entry. It must be recoverable and introduce the entry with recover the sunk investment must be existing railroad one of the time of the period with the hypothetical entry with the different time of the exposed the different capital building incumbents for the insurance. From the railroad accounting principle perspective of the treatment and entry of the existing barrier for the standalone cost analysis must be separated with the barrier issue with the manner of the principal issue with the detail of the implementation of the principle as part of the principle the exclusion and entry of the exterior barrier for the necessary for the standalone cost to conform with the contestable market for the upon with the standard accounting maximum rate. Total base, however, the acceptable approach for identifying the quantity of such barriers must be numerous. The best approach details a unique circumstance of each of the case. Consequently, railroad appreciation, railroad accounting principle board shows the new suggested methodologies determining entry and existing barrier cost of the implementation matter of the approach of the addressed within each of the case by the Interstate Commerce Commission. According to one of the commenting party, the compensated transition to be implemented with the Interstate Commerce Commission changed that as the valuation approach of the maximum regulation. The party agreed with the historically Interstate Commerce Commission originally asked that the valuation for the maximum rate of the regulation adoption of the current marketplace as the valuation trend of the net original cost, the standard alone cost of the Interstate Commerce Commission challenged the value of the valuation of the approach. Compensated transitional mechanisms are included with the railroad accounting principle. The sense of the railroad accounting principle board is limited to establishing principles guided on the standalone cost of the computation of the transition if it does not permit the computation economically accurate with the standalone cost. Rather, the implementation mechanism directed toward the alleviating perceived inequity resulting in moving from one regulatory policy to another. The railroad accounting principle board are likely to result in economic dislocation and inequitable treatment of certain railroad shippers, and the transitional mechanism issued by the Interstate Commerce Commission alleviate the problems. However, the transitional mechanism is dependent with the computation of the economic accurate results. Capital recovery. The two capital recovery methods, utility method, DCF method, used considered with the railroad accounting principle. Under the unit method, the capital cost determined each for the year multiplying with the net depreciated asset based on the cost capital, depending with the figure annual depreciating expense usually based on the straight line depreciation. Under the DCF method, also called the capital budgeting approach, the profitable investment venture must produce cash flows with a discount at a cost capital rate equal or exceed the initial cash outlay with the maximum rate of purpose for the equivalent cumulative present value of the cash flow must equal the hypothetical competitors' initial cash outlay, since the return in excess of the capital cost of capital are not permitted. Annual cash flow comments from the DCF approach for the necessary level. For example, the annual cash flow assessment of the recognized tax of effective the accelerated depreciation must recognize the expected inflation rate and change with the productive assets change with the demand. Assume the rates are based on the time of the capital recovery with differ the alternative approach for the time of the pattern under the ultimate approach one higher level cash asset. The earlier years relatively low capital costs. In later years, the time pattern under the DCF approach which depends on the productivity asset over the time. The productivity asset is constant over the time lifetime. The DCF approach provides level annuity. If the productivity declines even more over time, the DCF approach may cover more closely with the utility approach. The difference between the two approaches is illustrated with the two railroads, one entire new asset, one within the same assets that compromise the max vintage value error current with the marketplace. Under the utility approach, the railroad entirely new asset that exceeds the higher capital cost of the first year of the railroad makes for the asset. Under the DCF approach, the productive asset for both railroads and constant over the entire lives. The other begins with the equal, such as the tax depreciation. The railroad would have the same capital cost. In the DCF case, the vintage of the railroad assesses are immaterial. If the productive asset of both railroads decline even over the time, the DCF will approach the capital charge similar to the previously described under the utility approach. The railroad accounting principle of the DCF approach that systematic standalone cost analysis permits the flexible time of the pattern capital will recover the configuration of the hypothetical theoretical competitor of the flexible may be necessary, so the hypothetical competitor may earn the current market rate of return opportunity cost of the value is estimated. The relative of the pattern for the capital return must be the yield of the market returns on the current market value asset, the base of the competitor's relative life. The exterior barrier does not exist in the standalone cost. The pattern of the capital recovery will not allow the hypothetical new entrant, the new entry, to earn a capital return on the assets of employed value, and the opportunity cost will require result in liquidation and evaluate investment of existing markets. The absence of existing barriers suggests that the capital recovery programs may conform to those generated with the utility method. Any of the predefined method of the capital recovery, the possible inability of hypothetical to recover the relatively high capital cost in the early years under the utility method may be precluded with the utility capital recovery the parent. Conservatively, the possibility of the traffic volume declining with the standalone parameters last year might not be permitted with the capital recovery patterns with reflective relatively high compatible cost in later years. An example of the DCF approach is incorporated with the application of cost of capital asset valuation principle shown in Figure 1 of the following page. For example, the starting with the revenue set with the way with the indexes as expected inflation rate, the present value of the resulting cash for the overlay for the existing equal to the original asset base investment. All right, according to several commenting part of the railroad accounting principle endorsed the now prescribed the standalone cost method required rather than the railroad accounting principle showing the inflexible in commuting with the standalone accounting. Each maximum rate of the cash case may involve the particular circumstances which are unique to the application of relatively new and as a result is still evolving. The railroad accounting principle is not intended to prescribe a detailed CFF computational method, nor does it intend to preclude the use of the alternative capital recovery methodology consistent with the railroad accounting principle to accommodate the particular circumstance assumption in each of the cases. The railroad accounting principle, the specific computation method consistent with the principle must be specifically followed. The example of representation, one of the most capital recovery application of the standalone costs. This shows the example of the cash flow, discounted cash flow, which is DCF, application of standalone costs. Alright, this is by the value of the original sheet, the operating cost rate of the inflation statutory tax related accelerated depreciation factors, capital rate equation to start revenue amount substituted, inflated with the revenue amount to produce the net present value of the capital cash flow equal to zero may be determined. The discounted cash flow approach with the advantages that directly recognize the tax consequences arising from the hypothetical competitors asset. They eliminated the need for the separated the index various components of the standalone cost for the avoid the double counting capital cost inflation effects on implementation. Ex parte number 347 subpart number 1 the guidelines either the precise costing methodology not endorsed in the projecting general approach to determine the standalone cost. If these guidelines are addressing the cost issue, they are consistent with the application of railroad accounting principle board's principles of standalone cost. While two proceedings have been decided with under the Interstate and Commerce Commission, the maximum rate guidelines railroad accounting principle guards are generally consistent with the intent with the Interstate Commerce Commission standards. Chapter 11, Competitive Access.